All right, let's dive into this explainer. Today, we're demystifying derivatives, the tools, the players, and the very real peril. These instruments are used to transfer an incredibly wide range of risks across the global economy. So we're going to break down exactly how they work, who's actually using them, and, well, what happens when they go disastrously wrong.
We're starting with a number that is frankly staggering, $558.5 trillion. That represents the estimated principal amount outstanding in the over-the-counter derivatives market as of late 2019. Just to put that gigantic number into perspective, the value of the assets underlying these transactions is literally several times the gross domestic product of the entire world. It's a scale that is almost impossible to comprehend.
So, a massive number like that forces us to ask a pretty big question. What exactly is this hidden market that's powering the global economy? While traditional stocks and equities are always dominating the daily headlines, the derivatives market is actually significantly larger. It operates just out of view, yet it impacts almost every single facet of global business.
Now, the crucial thing to understand here is that a derivative is not a standalone asset. Its value is, you guessed it, derived from an underlying variable. Usually, that's the price of a traded asset like a stock or a currency. But honestly, they can be dependent on almost anything. We're talking agricultural prices or even local weather patterns, like the amount of snow at a ski resort. You're essentially entering into an agreement today about a transaction that's going to happen in the future, all based on how those variables change.
And when you compare the two sides of the market, the true scale of this financial iceberg really comes into focus. You've got the $96.5 trillion exchange-traded market, which has standardized contracts and clearinghouses to manage risk. But beneath the surface, that's where you find the towering $558.5 trillion over-the-counter or OTC market. This whole invisible world consists of private, customized trades made directly between massive financial institutions, fund managers, and giant corporations.
Now, you might be wondering where all this came from. These complex instruments didn't just appear out of nowhere. They actually evolved from very practical, everyday needs. Way back in 1848, the Chicago Board of Trade was set up simply to bring farmers and merchants together to standardize grain quality. Within just a few years, they developed the very first to-arrive futures contracts. Fast forward to 1973, and the Chicago Board Options Exchange starts creating an orderly market for stock options. So what literally started with corn and wheat has evolved into the massive financial engineering we see today.
Section 1. The Derivative Toolkit. Let's look at forwards, futures, and options.
There is a really critical distinction to make between these tools. Forwards and futures are strict obligations, whereas options act a lot more like an insurance policy. Basically, if you enter a forward or futures contract, you are legally locked in. You have to buy or sell that asset at the agreed-upon price no matter what the market is doing. With an option, though, you pay an upfront fee for a right, but absolutely no obligation. If the market suddenly moves against you, you can just choose not to exercise your option. Your only loss is that initial fee you paid. Pretty neat, right?
Moving on to Section 2, the players, specifically the hedgers, the speculators, and the arbitrageurs.
So every single participant in this ecosystem has a completely different motivation. Hedgers are out there looking to reduce or even avoid risk entirely. Speculators, they're doing the exact opposite. They use these tools to take on risk and bet aggressively on where the market is heading, often using leverage. And the arbitrageurs, they're the sharp-eyed opportunists. They're constantly scanning for riskless profit by exploiting tiny price discrepancies across different markets. Let's break down exactly how each of these players operates in the real world. Let's kick it off with a hedger. Imagine a US company. We'll call them ImportCo. And they know they have to pay a British supplier £10 million in 3 months. If the value of the British pound suddenly skyrockets, that payment could end up costing ImportCo millions of extra US dollars. That would completely blow up their budget. So by using a forward contract, ImportCo can lock in an exact exchange rate today. They're essentially buying peace of mind against crazy currency fluctuations. They aren't trying to make a profit on this trade, they just want absolute certainty.
On the flip side, a speculator uses that exact same tool, but definitely not for safety. They use it for leverage. Instead of paying full price to buy currency up front, a speculator can use a futures contract by putting down a relatively small cash deposit, which we call a margin. That tiny margin lets them control a massive amount of currency. If their hunch is right, the return on that small deposit is absolutely astronomical. But if they're wrong, their losses are magnified just as much. It's a highly profitable or highly disastrous bet.
And then, of course, we have the arbitrageurs. Say a company's stock is trading at $120 in New York, but based on the exact exchange rate that day, it's trading for the equivalent of $123 in London. An arbitrager will jump in, simultaneously buying the cheaper stock in New York and selling it in London. Boom! They lock in a completely riskless $3 profit per share. Now today, these opportunities usually vanish in fractions of a second thanks to modern algorithmic trading. But it's this constant, aggressive hunt for discrepancies that actually keeps global market prices perfectly aligned.
Which brings us to Section 3, when derivatives go wrong, the peril.
This dark side, this extreme peril, is perfectly epitomized by the incredibly complex and ultimately fragile structures of too-big-to-fail institutions, like Lehman Brothers during the 2008 financial crisis. You see, when times are good, Wall Street has this terrible tendency to just ignore their risk managers. Financial institutions built these massive interwoven networks of over-the-counter derivatives based on assets like subprime mortgages. Everyone just assumed the good times were going to keep rolling forever. And that kind of hubris, it almost always comes straight from the top. Listen to this aggressive quote from Lehman's CEO at the time, Dick Fuld. "Every day is a battle. You have to kill the enemy." That perfectly captures the extreme risk-taking culture of that era. Instead of using derivatives as tools for stability and hedging like they were designed for, they weaponized these financial instruments in a daily battle for outsized profits. They completely lost sight of the underlying risks they were piling up. That reckless culture resulted in a truly terrifying reality, a 31-to-1 leverage ratio. Because Lehman was an investment bank, it just wasn't subject to the same strict capital regulations as your standard commercial bank. Operating at 31-to-1 leverage basically meant that a mere 3 to 4% drop in the value of their assets would instantly, completely wipe out the firm's entire capital base. They were literally walking a tightrope without a net. And because of the interconnected nature of the OTC market, they absolutely weren't walking that tightrope alone. When Lehman finally fell, they had over 1 million over-the-counter derivative transactions tied to roughly 8,000 different counterparties. So their collapse triggered massive systemic risk. It acted like this terrifying financial domino effect, spreading across the global economy. If Bank A fails, Bank B takes a huge loss and fails, which takes down Bank C, and, well, you get the picture. But the peril isn't just systemic from the top down. Sometimes the danger comes from right inside the house. Take the French bank Société Générale in 2008. A single rogue trader, Jérôme Kerviel, was supposed to be looking for safe arbitrage opportunities. Instead, he used his inside knowledge of the bank's systems to create fictitious trades, completely disguising massive unhedged speculation as safe arbitrage. When his positions were finally unwound, it evaporated 4.9 billion euros. It is a brilliant, terrifying illustration that an instrument designed to reduce risk can become a massive weapon of financial destruction if internal controls fail. So, we've seen how vital these tools are for businesses trying to protect themselves, and just how incredibly dangerous they become when leveraged for pure speculation by interconnected financial giants. As we wrap up this explainer, I want to leave you with one critical thought. The next time you look at the global markets, you have to ask yourself, are derivatives essential economic stabilizers, or are they systemic risks just waiting to ignite? Thanks for hanging out with us, and keep asking the big questions.